Debt versus equity investments. What's best for your portfolio? To make money in financial markets, you can buy and sell a variety of securities, the most popular of which fall into two categories: debt and equity. The risks and rewards associated with each type of security are different, so successful investors like to blend both types to achieve proper portfolio diversification in the long run. Find out what could be the best option for your own portfolio. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. I'm doing marvelous, and if you are doing as marvelous as I am, go grab a cup of coffee or tea or vodka. And let's go. Today I'm going to talk to you about debt versus equity investments and what's really best for your portfolio. And I want to start with investing in equity. I want to walk you through what are the basics of equity investments. Now, basically, when you make an equity investment, you issue you are given shares in exchange for capital that you put into the company, and you become a shareholder or owner of the company, right? There are two types of equity securities that are issued by companies. You have something called preferred and common. So you have preferred stock and common stock. I'll come back to the preferred stock definition later on. Now, you have to understand is that prior to making an investment in preferred equity, it's important to understand the additional features attached to preferred shares. So right now, we're just talking about common stock. Now, if you own stocks in a company, whether it is a private company or a publicly listed company, you get dividends, all right? So the dividends is declared by the board of directors, and you get dividends every quarter, every 6 months, every year, whatever the timing is, all right? Now, let's talk a little bit about preferred shareholders, preferred stock. Now, if you have a preferred stock, as the name implies, you have some kind of priority when it comes to things like dividends. So you get dividends before common shareholders, and you also have some kind of a preference in the event of liquidation. So in the event of a liquidation or acquisition, preferred shareholders will receive back at least the original investment value and a multiple thereof before any distributions are made to common shareholders. All right. Also, another thing that you need to remember is that some preferred equity structures include participating provisions, whereby you, as a preferred shareholder, you will receive a multiple of the original purchase price. Okay. Now, there are some conversion features. There's something called you can convert the shares into common shares, right? So if you buy a preferred stock, you might have a 1-on-1 conversion ratio or a 1-to-2 conversion ratio. That means that one preferred share of yours can be converted into two. Now, you got to really read the agreements, the share agreement, the share sale contract before buying, so that if you wanted to convert your preferred shares in the future, at least you have an idea of what they'll go for. Now, if the company is publicly listed, it's easy because everything is online. You can contact the investors relation of the company, and they'll take care of you. They'll answer all your questions and everything. But if you have a private company, it might be a little different. You're going to have to contact them, but actually, talk to someone, maybe face to face. All right. There's also something called pay-to-play provisions. So pay-to-play provisions, usually companies use that to incentivize early investors to participate in future financing rounds. In other words, if you are, let's say you just injected $500,000 in a company, and there might be a pay-to-play provision that says if in the future, 3 years from now or 2 years from now, you inject another $500,000 or even $1 million into the company, you have some kind of rights and privileges. All right. So those are usually associated with preferred stock. All right. So this is very important. Now, if you own a company's, again, folks, we're talking here about equity investments, right? Equity investments fall into two categories: preferred equity and common equity. If you invest in a company's equity, you have a say in how the company functions. You can vote. You can even elect someone to the board of directors. All right. And this is very important, especially when it comes to hiring top management. This is very important. Hiring and setting the compensation level for top management. Now, there are some risks involved in investing in equity. All right. The primary risk involved here is that you may lose part or all investments and principal. What I'm trying to say here is that there is no guarantee of dividends or return of investment. You might buy a company's share today and the share price might actually might fall. So those prices are subject to fluctuations, and you can't control them. All right. Now, I'll talk about debt very soon, but unlike debt instruments, you're not guaranteed a stable cash flow stream. You're not guaranteed some kind of a financial security, right? So this is very important. So the risk here is that you might lose part or all of your investments. All right. Now, the thing here is that if you're a common shareholder, your risk is even higher because your rank in the capital structure of the company you invested in is very low, because the preferred shareholders get paid before you do. So this is very important to really think about those ramifications before putting your cash in a company on the equity side. All right. Now let's talk about the debt side. I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still having a conversation right now about equity investments and debt investment. I already spoke to you about equity investment and now debt investments. We want to talk about that. Now, what is debt? If you like the content so far, please consider subscribing to our channel and turning on the notification bell so you can be informed whenever we drop a new show. You want to comment, share, like. Now, what are the basics of debt investments? Now, you have to understand, in a debt transaction, in a debt funding transaction, there are two parties, right? So you have the creditor, the lender, and the debtor, the borrower, right? So in exchange for money, the debtor, in this case the company, will issue a loan or something called promissory note to the investor, in this case the lender, the creditor, right? So you have things like things that are very important to know. The principal, that's the amount of money you originally invest in the company. The interest rate is the percentage rate, usually is quoted annually, but the company can pay you quarterly or semi-annually or even annually, it depends. As long as the loan is outstanding, you will receive interest income, right? So you have something called amortization. There's an amortization schedule that explains in great detail how soon you'll be getting, how often rather you'll be getting your money, your interest. And let's say you have, you buy bonds, right? Bonds are debt instruments. You buy bonds for 10 years and the maturity is 10 years and you're getting paid every quarter. So you're getting paid 4 times a year times 10, that's 40 times. So, and then that payment plan, also called amortization schedule, will show for each quarter from today until the 40th quarter how much you'll be getting and the amount of the outstanding loan. All right. Now, if there is default, that means that the borrower is not able to make timely payments of principal and interest. So this is very important. Okay. What are the advantages of debt investment? There are a lot. I mean, the first advantage is that you get income from interest payments over the life of the loan, right? Another advantage here is that you have security, because you have to understand when it comes to the capital structure, let's say you have a liquidation or a bankruptcy, debt actually sits at the very top of the capital structure, right? So usually lenders are paid first, right? Another thing you need to think about when it comes to a debt investment is that debt transactions usually include security provisions that are tied to certain assets of a debtor, providing an even higher level of security to creditors. Think about when you buy a car, when you get a car loan, right? The car title, the title of the vehicle sits with the insurance company or with the lender. In other words, the car serves as collateral to the loan. The same thing happened when it comes to some types of debts, whereby the borrower agrees to collateralize some assets, so that in the event of a bankruptcy or liquidation, the lender can come and take possession of the asset, sell it to be able to recoup some of his or her loss, some of his or her investments rather. All right. Another thing you have to understand here is that debt can be very simple. In other words, you just invest money in a company and you get paid every quarter. I mean, you get paid interest and a certain portion of the principal amount every year or every quarter. Or you can have a very complex financing structure. You can have a debt instrument that is what they call the convertible. You can have unsecured. You can have zero coupon. You can have floating rates. You can have revolvers, payment in kinds. We have an entire show focused on this particular concept of debts. So please go check it out and learn more there. One thing you have to pay attention to is that you can also, I was talking earlier about the conversion feature with preferred stock. You also have this one when it comes to debt. So you have something called convertible notes. So those are notes that can be converted, as the name implies. They can be converted at a predefined ratio into shares. So if a bondholder, for instance, wants to become a shareholder of a company, and there exists such a provision in the bond agreement, the investor, the lender, can do so. Now, what are the risks of investing in debt? Of course, I talked about the fact that debt sits at the top of the company's capital structure, but there are still risks attached to debt investments, right? So there are four. Economists talk about four primary risks when it comes to debt investments. Those are liquidity, inflation, interest rate, and default. Liquidity risk. This is the uncertainty. This is what happens when a given financial asset, security, or commodity cannot be traded quickly enough in the market to prevent or minimize the loss. In other words, if a debt instrument is illiquid, it means you can't sell it quickly. You have to wait, because the market is not deep enough. There are not enough buyers or sellers of the particular products. You have inflation risk, right? This is the likelihood that cash flow from an investment won't be worth as much in the future because of changes in the purchasing power due to inflation. The interest rate risk is, for instance, you are being paid, let's say 6%, but over 10 years, and over 10 years, the Federal Reserve has increased interest rates. So you're getting 6%, whereas you could have gotten 10% elsewhere. So you're actually losing money. And the last thing is the default risk. And this is the risk that a firm will be unable to make the required payments of principal or interest. And this may result in the loss of everything you invested. And this happens when a company is liquidated or has filed for bankruptcy protection. All right, I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still having a conversation here about debt versus equity investments, and just going to have an idea of what's best for your portfolio. So I spoke about debt, I spoke about equity. Now I want to speak to you about a combo of debt equity. Economists call it hybrid investments. So investing in hybrids. So, basically investing in hybrids means that you're investing in products that have characteristics of both debt and equity. All right. So basically, debt and equity may meet in the middle, offering investors the potential benefits of both. Now, you have to understand that the pros and cons of hybrid financing align with the pros and cons associated with debt and equity, right? So it's just another way of getting the best of both worlds. Now, what are the sources of hybrid capital? You have something called preferred capital. I spoke about that earlier. Preferred shares, convertible debentures. So convertible debentures are similar to convertible bonds. You have hybrid security that are sort of a structured hybrid security that investment banks usually and asset managers do for high net worth individuals. In some cases, you might also have options and warrants that can be grouped into hybrid funding sources. Now, we're preparing an entire show on options and warrants, so I'm not going to go too much in details here, but just know for now that options and warrants are sources of hybrid capital. Now, when it comes to investing in hybrid securities, an investor should consider a few things, right? So you have the risk factor, right? I think I kind of talked about it earlier, that the risk is similar. The risk is more a combo of the risk you would face if you were investing in stocks and bonds. The return. Now, hybrids usually don't offer guaranteed return. Again, this is basically something you have to see to make sure that it aligns with your particular investment profile. You have to think about cost, the investment horizon, whether you invest in a long term or a short term. It really depends on you. Your financial goals. Another thing you have to pay attention to is the fiscal aspect of things, right? Because there are taxes on capital gains, and they fluctuate between 10 and 15%. So you want to think about that. And remember, though, that the debt component of hybrid securities is taxable as any other fund. So you want to make sure that you basically, plan optimally your fiscal strategy before getting into any kind of, hybrid investments. Now, one last thing I wanted to say here in terms of hybrid investment is that hybrid securities are generally complex in nature, with potentially higher risk than any other forms of investment, right? You have to understand that anytime you talk about debt, there is something called a credit rating agency attached to the equation. So you want to make sure that, and the way it works is that the higher the risk, the lower the credit rating. And the higher the credit rating, the lower the risk. So the price and interest rates fluctuate accordingly. So this is something you have to pay attention to. All right, I will see you right after this. Do not go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are about to wrap up today's conversation, and for those who just joined us, and the context of today's conversation was very simple. To make money in financial markets, you can buy and sell a variety of securities, the most popular of which falls into two categories: debt and equity. The risks and rewards associated with each type of security are different, so successful investors like to blend both types to achieve proper portfolio diversification in the long run. Now, I've shown you what could be the best option for your portfolio based on the characteristics of each type of security. So I explained to you what investing in equity entails, right? The basics, I went over the basics: dividends, liquidation preference, the conversion features, the pay-to-play provisions, the board of directors authority, and the risk of investing in equity. And then I spoke about investing in debt. I covered the basics, the advantages, the key features, the risk of investing in debt. And finally, I talked about investing in hybrid financing. Again, I explained what it was, the sources of hybrid capital, things you should know before investing in hybrid securities, and the risk of investing in hybrid instruments. All right, now this is very important. Now I want to sort of talk about something before I wrap this up. There are 6 important tips for first-time investors here. You want to understand the risk. Whatever whether you invest in a startup or an established company, you understand that there is a risk attached to it. You want to be able to invest in multiple deals so you can spread the risk across the board. Understand that it takes time for returns to mature to actually start making before you start making money. Be there and follow the company you have invested in. Read more, read about them, do a Google alert so that anytime there's something going on that particular company, you get an alert and you can read about it. Familiarize yourself with the industry. If you haven't done beforehand, it's never late to do so. All right? Thanks so much for listening, and I will see you next time. Remember, stay marvelous.